There is no understanding markets without understanding people. Quote, Dr. Daniel Crosby, The Behavioral Investor by Daniel Crosby. The Behavioral Investor by Daniel Crosby dives deep into psychology of investing and talks about biases, fallacies, and various other factors that impact the choices while investing. Four behavioral risks that can significantly impact and diminish your investment turns. Ego. Ego-driven decision-making can be detrimental to the investment success. When investors become overly confident in their abilities, they may take excessive risk or ignore warning signs. Ego often leads to overestimating one's knowledge and underestimating market complexities. It can result in overtrading, chasing trends, and resisting necessary changes to investment strategies. Successful investing requires humility and the acknowledgement that markets are unpredictable. Conservatism. Conservatism in investing refers to an aversion to change or reluctantly to update one's views in light of new information. Investors may stick to outdated strategies, missing opportunities, or failing to adapt to evolving market conditions. While consistency is important, rigid conservatism can lead to miss opportunities. Markets evolve and successful investors adapt. Conservatism might cause investors to hold onto a losing position or ignore signals suggesting a shift in market dynamics. Attention bias. Attention bias occurs when investors pay too much attention to compelling narratives or stories, neglecting the importance of mathematics, statistics, and analytics in decision making. Investors are drawn to captivating stories that resonate emotionally. However, relying on narratives without considering data-driven analysis can lead to poor investment decisions. A balanced approach involves integrating both compelling stories and objective analysis. Emotion. Emotional decisions making can cloud judgment and lead to impulsive actions based on fear, greed, or other strong feelings. Emotional reactions often deviate from rational long-term investment strategies. Emotions such as fear of losses or the thrill of potential gains can drive investors to make hasty decisions. Successful investors maintain discipline and avoid being swayed by short-term emotion. Emotional decisions tend to result in buying high and selling low and overall poor portfolio management. Key takeaways. To enhance investment returns, investors must be mindful of these four behavioral risks: ego, conservatism, attention, bias, and emotion. Overcoming these challenges involves cultivating self-awareness, staying humble, remaining open to new information, incorporating data-driven analysis, and keeping emotions in check. By addressing these behavioral risks, investors can make more informed and rational decisions, ultimately improving their long-term investment outcomes. How to manage the four behavioral risks. Ego, spread the wealth. Recognize that no amount through analysis can provide absolute protection from unforeseen events in the market. To mitigate the impact of unexpected occurrences, diversify your capital across a range of investments. The suggestion is to aim for a portfolio of 10 to 20 investments. This strategy is grounded in understanding that risk measured by volatility returns tends to escalate rapidly with only a few concentrated investments. Number two, those who can teach. Acknowledge that a true test of your understanding and confidence in an investment decision lies in your ability to articulate and convince others. If you are generally comfortable with your chosen investment, it should be straightforward to explain it and persuade someone else to understand and support your choice. Teaching others not only reinforces your understanding, but also invites diverse perspectives that can enhance decision making. Three, test, guess again. Cultivate a mindset of continuous questioning and testing assumptions. Make it your mission to scrutinize and challenge your most fundamental beliefs about investments. Instead of settling for the initial assumptions, adapt a proactive approach of guessing again and reevaluating your decisions. This ongoing process of self-examination helps to uncover potential blind spots and refine strategies, and ensures that your investment decisions remain robust, adaptive to changing circumstances. The next behavioral risk, conservatism. Number one, procrastinate just a little. Allow yourself the luxury of time when making decisions. Procrastinating just a little can provide the necessary space for careful consideration, allowing you to make informed and deliberate choices. Recognize that the markets often extend a bit further than anticipated, and exercising patience can prevent rush decisions that may lead to suboptimal returns. Number two, no regrets. Avoiding regrets is crucial in maintaining a healthy and proactive investment mindset. Regrets can lead to decision paralysis, negatively impacting your investment returns. To counter this, embrace a rule-based system for selecting stocks. This approach, based on predetermined rules and criteria, reduces emotional decision-making and fosters a disciplined and regret-free investment strategy. Number 3, flip the script. Challenge your perspective by flipping the script when evaluating an investment. Instead of solely focusing on why you want to invest in a particular security, such as XYZ, consider asking yourself, why wouldn't you want to invest in it? By examining the potential downsides and looking at the system from all angles, you can conduct a move through an objective analysis. This approach helps uncover hidden risk and provides a more balanced view, guiding you towards a well-informed investment decision. The next behavioral risk, attention bias. Number 1, play the odds. Counter attention bias by focusing on statistical probabilities rather than compelling narratives. Financial news during a market turmoil often emphasizes dramatic stories, but it's essential to play the odds. Remember that on average, the S&P 500 exhibits a 7 to 8% annual increase. Even in a bear market, historical trends suggest that markets have a tendency to rebound. By prioritizing statistical likelihoods over grabbing stories, you can maintain a more rational and objective approach to investment decisions. 2, look for simple solutions. When attention bias leads to overwhelming focus on specific details, consider adapting a rule-based system. Such a system can simplify decisions making, incorporating predetermined rules and criteria. This approach prevents the investor from getting lost in the minute of individual aspects of an investment, allowing for a clearer view of the entire investment landscape. Number 3, consider solution size. Recognize the size of the solution is as crucial as its likelihood. In evaluating potential events or scenarios, it's not only important to gauge their likelihood, but also assess the potential impact and magnitude of the consequences if these events were to occur. By taking both factors into account, investors can move well-rounded decisions and consider not only the probability of an event, but also its potential size and significance in a broader context of their portfolio. This approach helps in avoiding a narrow focus probability along promoting a more comprehensive risk assessment. The last of the 4 behavioral risks, emotion. Meditate. Emotions in financial markets often boil down to either fear or greed. Meditation proves to be a valuable tool for taming both of these powerful emotions. By practicing mindfulness through meditation, investors can gain better control over the emotional responses to market fluctuations. This increased self-awareness allows for more rational decision-making, mitigating an impulsive action driven by fear or excessive greed. 2, automate with artificial intelligence. To counter the influence of emotions, particularly fear and greed, consider implementing an artificial intelligence-driven rule-based system. Automation reduces the impact of emotional decisions by relying on predetermined rules and criteria. This not only helps you in removing human emotions from investment process, but also ensures investment adherence to a strategic plan, improving the overall behavior and discipline of the investor. Number 3, learn to recognize emotions. Developing the ability to recognize and understand one emotional state is crucial for avoiding impulsive decisions in the market. By learning to identify periods of heightened emotions, investors can take a step back during such times and refrain from making decisions that may be influenced by the emotional bias. Recognizing emotional triggers allows for a more measured and rational approach to investing, aligning decisions with a well-thought-out strategy rather than succumbing to the fluctuations of the market and emotional responses. How to design a winning rule-based system. You may have observed recurring theme, the common denominator in addressing many of the challenges posed by behavioral risk in the market. A potent solution lies in implementation of a rule-based system for your investing approach. This channel providing market overviews, highlighting sectors to watch for, and pinpointing individual securities every 3 days operates on the foundation of a rule-based system. A rule-based system entails establishing a structured framework to guide investment decisions. Rather than relying on intuition, emotions, or subjective judgments, a rule-based approach involves predetermined rules and criteria. These rules serve as a systematic and objective bias for making high-probability decisions in the market. By adhering to a rule-based system, investors can achieve several benefits. First and foremost, it helps to counteract the influence of behavioral biases such as ego, conservatism, and attention bias and emotion. The systematic nature of the rule prevents an impulsive actions and emotional reaction, fostering discipline in the decision-making process. Moreover, a rule-based system introduces consistency and repeatable in investment strategy. It provides a clear roadmap for navigating various market conditions, promoting a steady and methodical approach that remains resilient in the face of uncertainties. Additionally, a rule-based approach facilitates the automation of certain aspects of the investment process by translating a decision-making criteria into rules. Investors can leverage technology, including artificial intelligence and algorithms, to execute trades and manage portfolios. That not only enhances efficiency, but minimizes the potential for human error and emotional interference. In essence, the adoption of a rule-based system aligns with the principle of intelligent investing. It encourages a disciplined, systematic, and objective approach, mitigating the impact of behavioral risk and fostering a more resilient and consistent investment strategy. Implementing a rule-based system in your investment approach serves as a safeguard against various pitfalls. It shields you from succumbing to a blown-up ego, preventing falling into the trap of paralyzing conservatism, mitigates attention-related issues, and acts as a buffer against the tumultuous ride of emotional highs and lows. The intellectual challenge of constructing such a framework is part of its rewarding nature. Crafting a systematic set of rules requires thoughtful consideration, analysis, and foresight. This intellect engagement not only helps you develop a robust strategy, but also contributes to the ongoing refinement and improvement of your investment approach. In navigating the complexities of the market, the rule-based system becomes a source of structure and rationality, steering clear of the behavioral bias that can otherwise impede such decision-making. A winning rule-based system has three different factors that it must satisfy. Empirical support stands out as the most evident criteria among the 3 points. Your rule-based system must demonstrate its profitability when scrutinizing its historical performance. Examining how the system has fared in the past provides tangible evidence of its effectiveness and reliability in navigating diverse market conditions. Theoretical support complements empirical evidence, emphasizing the delving into serious data sets is crucial. Simply relying on empirical support might lead to correlations, instances where data moves in tandem without a substantive connection. Beyond historical performance, your rule-based system must also align with the theoretical reasoning, ensuring that its principles make logical sense and are rooted in a sound understanding of the underlying dynamics, enhancing the overall robustness of your investment approach. Daniel Crosby raised an intriguing point about psychology pain in the context of successful rule-based system. According to him, a winning system not only withstands the test of time, but it also mentally challenging to adhere to. The difficulty in adhering to the system acts as a protective mechanism. If a system were too easy to follow, as soon as it becomes widely known and popular adapted, its profitability would vanish almost immediately. Therefore, the psychological challenge of staying true to the rule-based system serves as a safeguard, preserving its effectiveness over the long term. Why value investing works on a rule-based system. While I am not personally identified as a value investor, many attest that this system aligns with the 3 requirements. Often credited to Benjamin Graham and famously endorsed by Warren Buffett, value investor revolves around the purchasing of stocks priced below the intrinsic value of the company. These stocks typically boast low valuations of assets and earnings. Interestingly, such companies are not commonly praised in financial news, if mentioned at all. The efficiency of this approach lies in the ability to capitalize on the market's tendency to undervalue fundamental sound companies, presenting an opportunity for patient investors to benefit from eventually correction of these undervaluations. Empirical support strongly favors the efficiency of value investing. For instance, low price to book stocks constantly outperform their high price counterparts, achieving a 100% success rate over a 5-year period. Even within the shorter time frames, the trend persists with low price to book stocks surpassing high price ones 73% of the time over a 1 year and 90% over 3 years. Notably, from 1963 to 1990, the least expensive stocks measured by the price to book ratio yielded returns almost 3 times higher than the most expensive ones. Extending this period to 2009, the cheapest stocks gauged by the price to earnings ratio delivered an impressive annual return of 16.25, significantly outperforming the index's 11.22% return. This empirical evidence underscores the consistency and the effectiveness of value investing strategy over a prolonged period. Theoretical support for value investing aligns with common sense consideration. A rational choice emerges when faced with the question of whether to pay a higher price for a stock that yields the same return as a cheaper alternative. Initially, a value investor would lean towards the more affordable stock as it presents the opportunity to attain equivalent financial gains while minimizing the initial investment. This theoretical rationale reflects the core principles of value investing, seeking stocks priced below their intrinsic value to maximize returns over time. Psychological pain is inherent in implementation of value investing due to the mental challenges it presents. Value investors are typically priced low for specific reasons. Perhaps a company has recently faced a scandal, operates in an unattractive market, or has experienced a decline in profits. Regardless of the case, these companies are often frowned upon by the wider investment community. Swimming against the current or going against the prevailing market sentiment is inherently difficult, especially when adhering to a strategic that seeks low valuations. Being a value investor demands patience, as it requires waiting for the markets to recognize and reflect the true value of the company. Staying committed to such a strategy amidst prevailing skepticism can be mentally taxing. Why momentum investing works in behavioral psychology. My rule-based system incorporates various indicators, with momentum investing standing out prominently. In addition to leveraging historical data analytics, my approach integrates the insights derived from technical analysis. By incorporating these diverse elements into the system, I aim to create a comprehensive framework that harnesses the power of analytics, historical trends, and momentum-driven strategies to guide sound investment decisions. Isaac Newton's law that an object either stays at the rest or maintains constant velocity finds its parallel in the financial realm. The fundamental principle translates to momentum investing, where stocks exhibit either upward or downwards movements. The core tenet of momentum investing adheres to this philosophy of letting your winners run and cutting your losses short, an expression reversed by momentum investors. Delving into why this approach works involves an exploration of the dynamics that drive the continuation of trends of the financial markets. Empirical support solidifies the case for momentum investing. Stocks that outperform the market in one year consistently demonstrate a tendency to maintain that outperformance in a subsequent year. This trend is notably pronounced when examining one-year units from 1920 to 1935, showcasing a strong likelihood for stocks surpassing the market in one year to repeat the feat in the following year. Beyond this, a consistent pattern emerges where winning stocks continue to outperform losing stocks on average over the subsequent 6 to 12 months. Remarkably, the enduring nature of momentum effects in the United States dates back as far as 1801, underscoring the enduring validity of momentum investing principles. Theoretical support for momentum investing finds grounding in psychological and behavioral factors. Greed emerges as a potential explanation, where the desire to capitalize on profitable investments drives individuals to follow the lead of successful peers. If a friend achieves gains in a particular investment, the inclination to replicate the success becomes a driving force. Additionally, a slow reaction to publicized data serves as another theoretical explanation. Investors may take time to process and fully absorb new information, resulting in a delayed response to market developments. This lag in reaction time contributes to the persistence of momentum effects as the broader market investor community gradually adjusts to evolving market conditions. Psychological pain is inherent in the challenges of momentum investing. The difficulty lies in the reluctance to let go of leading stocks and selling winning ones, even though it may seem counterproductive. From my perspective, the behavior makes sense symbolically, as selling a stock at a higher price than the purchase entails a securing a profit. On the flip side, losers that have been sold still retain a chance to recover and transform into profits, although in practice, this transformation often remains elusive. This psychological dilemma underscores the complex interplay between emotions and the rational decision-making in the world of investing. Final conclusion: a rule-based strategy serves as a crucial antidote to common pitfalls of emotional decision-making in investment. It introduces a disciplined approach to trading, eliminating the impulse urge to buy stocks fueled by excitement about potential gains or to sell stocks hastily in response to negative information. In essence, a rule-based system is a structured mechanism that applies predefined rules to store, sort out, and manipulate data. For effective operations, such as systems rely on the foundation of factual information or data sources accompanied by a set of rules that govern the manipulation of that data. Rule-based investing operates on a set of stringent guidelines essential following a series of straightforward if-then rules. rules. If the core principles of this strategy emphasize the importance of having the right rules in place, devoid of emotional influence, by adhering to these rules, investors can eliminate guesswork and make decisions based on probability, fostering a more rational and objective investment approach. On this channel, a weekly exploration awaits, delving into our rule-based system, predictions, stocks, and insights derived from various indicators. If you find this content intriguing, we encourage you to subscribe and join our community. As we say, the catchphrase is simple yet powerful. Study it, analyze it, adapt it. Stay informed and engage with our rule-based approach to make informed decisions in your investment journey. Peace.